for those of us who've been talking about bullish gold forever, just to be able to say things like take profits is the essence of the business. And the problem with gold right now is it's so extended versus virtually every moving average, 200-day, 60-month, whatever. It just, if it doesn't have a normal 20 to 25% drawdown from the peak, it would be very weird. That's why I view gold right here as very scary for the implications for what it means for other markets, particularly with crude oil dropping. The extent of that has never happened. 2008, it didn't even get near as much as extreme as we are now. And for when people say gold might go to $5,000 an ounce, I just look at that. That's incredibly just frightening because it's moving so fast. Remember, it's a store of value. It's a rock. It's an ancient store of value. And when it goes up that much and everything else underperforms it, something's wrong. So I'm really indication, like you mentioned, that it's telling us that stock market volatility, that bottom, the 90-day volatility, bottomed just a few weeks ago at 8.9%. That's the lowest in 5 years. Might just pick up by the end of the year. And that means gold might be warning us some deflationary dominoes might be tumbling into year end. Crude oil is declining, bond yields are declining, and if stock market ticks a little bit lower, those trends will accelerate.
Okay, this might be an unanswerable question, but do we know why? What was the catalyst? Because gold had been extended for so long that when you actually got the pullback, it was kind of like, what triggered this? And I wonder, and just play along with me here, does it have anything to do with the heist at the Louvre where there was all this talk that people were going to sell off the jewels and the gold and melt the gold? And, you know, that was a sign that, maybe this has gone too far.
I think, Scarlett, that's a very low probability. It sounds great, it makes good headlines, but the bottom line is when markets when markets get this stretch, you have to dig into what's really driving the market. And it's actually not futures right now. The bottom line bid below the market has been central banks, and they're probably going to curtail their buying because around $2,000 an ounce for the last couple of years, it was a good value. But at $4,000 an ounce, there should be some elasticity there. So it's mostly the cash buying and selling. You hear in a lot of stories of extremes that are disparate extremes in silver and gold that usually pit near peaks. And as far as exactly why, I always try to ignore that and focus on the relative value, and that is it's just too expensive. You're not supposed to be going out of your way to buy it. And the bottom line is it's a complete pile-on, massive pile-on in ETFs and just on the social media. And as an ex-trader, when you see it being bullish everywhere, and if you've been long it, you say, okay, Mr. Broker, can you hit a bid for me?
Mike, this is the dumb question of the day coming your way. Do we measure volume of gold trading long, upside, downside, all that kind of stuff?
Well, it's the key metric as far as volume. One metric that really shifted this year is people pointed out the total reserves of gold and central banks surpassed the U.S. dollar reserve. Now, that's partly because the price went up so much. But as far as volume, sure, volume's picking up. We don't have the commitment to traders data, but I'll tilt over to what's really mattered is we have open interest. Open interest in futures on the COMEX has not really picked up with this rally. So it's also the biggest buying in the world is happening from Chinese central banks. So to me, it's just trying to dig into the little nuances is better off to say, so what's the last time it stretched this much above its 200-day moving average? It was 2006, and gold corrected about 25% from that peak, and then it went back higher. It's just not a level you're supposed to be overweight the metal. The key thing is what happens for the stock market for in the year. What's it telling us? And to me, it's telling us potentially to expect a pickup in stock market volatility.
All right, and we will definitely be on the watch out for that. I know that you look at charts, you look at technicals, and given that gold was at about 3,400 in late July and got to as high as 4,356 before it started to come down a little bit, what is the support level for gold in the near term?
Well, everybody's looking at, I'm glad you asked that question, Scott. Everybody's looking at 4,000, but a normal correction from this extreme is about 20%, which is around 3,500, which was the old peak. It bumped up to that level for 5 months and then broke out higher. The key question is what keeps it to stay strong above 4,000. And as a trader, you're just supposed to expect, well, that's normal. If it gets there, I'll buy it. But here, it's just the first dip. 4,000 is just the first dip, but it's not anywhere near the normal correction, which is 20 to 30% from this much of a stretched market.